Welcome, everyone. This is Tom Humphreys from the Mayor Brown Tax Department in New York. Here today with my colleagues, Ramelt Reigersman and Brennan Young. And our program is called the U.S. Taxation of Structured Notes. Now, before we begin, there are a few housekeeping matters we have to cover. So there's a couple of things. One, to ask any questions, please use the Q&A widget on your screen. We'll try to address the questions throughout the webinar. Otherwise, we'll get back to you via email. If you're seeking CLE credit today, please download the affirmation form and the evaluation form found in your resources widget on the screen. We'll announce the CLA code once during the middle of the presentation. And please return both forms for CLE credit. The presentation and supplemental materials are available for download from your resources widget. We will also distribute these via email after the webinar. So with that, with the housekeeping out of the way, let's get started on our program for today. So here's our agenda on slide 2. And the way we do this, what we found is most effective, is to give everyone a little history on structured notes, to talk about one very early, and I find quite interesting transaction, which we use to illustrate the tax issues that are raised when an issuer does a structured notes offering and when a holder buys a structured notes. From there, we're going to turn to structured notes and the tax classification. As with many things in the tax financial instrument space, it's all about classification. What is the instrument for federal income tax purposes? Because that then tells us the set of tax rules that we have to use to figure out the taxation of both the issuer and the holder. And we'll give you some examples of particular types of instruments. From there, what we're going to do is turn to specific, we call them select tax considerations. And these are a number of issues that come up across the range of structured note offerings. And we'll try to show you what the issue is. We'll try to show you how people deal with that issue. Many times there's an issue, but the resolution of the issue with regard to a particular note is not clear. And so we'll show you for how people deal with that, the kinds of disclosures they use, that sort of thing. So you see there's a number of different items there. And then at the end, we'll talk a little about the current state of affairs for structured notes, a word on the tax initiatives around COVID-19, and then if we have time, we will handle some Q&A. So with that, let's go on to slide 3 and a little history. So, and hopefully for tax lawyers and non-tax lawyers alike, we can explain this to you in a way that you'll understand. So before any regulation in this area, and by that I mean IRS issuance of regulations in this area, before any of that, from a tax standpoint, issuers and holders who looked at notes with contingent features, which is part of the definition of structured notes, were left with their normal methods of accounting. So those are the cash method of accounting or the accrual method of accounting. And so someone who bought a structured note way back when did not have any regulations to look to, and instead they were simply under the normal common law rules. Now, in the 1980s, Congress revised what are called the original issue discount rules. OID on bonds is currently includable in income, and revised those rules to cover situations where a note had one or more contingencies. And so that set of regulations, that code section 1275D, which you see on the slide, that's the basis for all the regulation by the IRS in this area, by the Treasury Department and the IRS in this area. You also see on the slide 1986, so it took about roughly 10 years for the Treasury and the IRS to experiment with a series of tax rules concerning the taxation of structured notes. And so the first batch of those, 1986, there was another batch which became proposed in the early 90s and then finalized in 1996, along with all the regulations dealing with original issue discount. And so as we see, those are the regulations that we're going to be talking about when we talk about holders of structured notes. And then for issuers, the issuers are typically the mirror image of that. So as I said, we lead this off with a little history. So I'll take you back, because I was there, to the land before time and talk about this instrument called dollar bills. So dollar bond index linked securities. Quite a clever name, I think. It wasn't my idea, but whoever came up with it, and I know who came up with it, very, very, very clever, or so they thought. So to understand the dollar bills, you have to understand a bond index, and this was the Lehman Brothers Corporate Bond Index Total Return. That index has been passed down from generation to generation. I think now Bloomberg is the index provider. So at the time, the Lehman Brothers Corporate Bond Index Total Return worked something like this. So if we had, as you see on the slide, 10 different 10% corporate bonds, all purchased on the index start date for 100, the index value, the initial value would be 1,000. So you look at the value of each bond, add up for 10 bonds, and we've got 1,000 index value. This is a total return index, or was a total return index, and so the interest payments were deemed reinvested in the index. And so very, very simply, if on the first payment date, 6 months out, all the bonds paid 5%, and all the bonds were still worth 100 at that time, then each $50 interest payment would be deemed to be reinvested in $5 par amount for each of the same 10 bonds. And so after 6 months, the index value goes up by exactly the amount of the interest that has accrued on the bond, which is 1050. So that was the index. It was a total return index, not on equities, which we're all very used to, but on corporate bonds. So what can you do with an index like that? Well, in this case, Merrill Lynch issued 100 million of the dollar bills. They were senior debt. They were principal protected, and that's a very important concept in our world of structured notes. Is the instrument, is the holder entitled to get their money back at maturity, or is there a principal contingency? Here, it was principal protected. The holder, in all events, would get their money back at maturity. And this is a nice, 10-year debt instrument. Now, there was no current interest payment on this bond, but the interest was payable at maturity only, equal to the increase, if any, in that Lehman corporate bond total index return from the start date to the maturity date. So the index value, as I've shown you, the index basically reinvests interest. And so at the end of the day, what you would have, the index value, would be that interest reinvested each 6 months in bonds over the term of the instrument. And so you would expect, assuming interest rates didn't get too crazy, that the bond would perform almost like an OID instrument, accruing income at 10% a year. But from a tax standpoint, and the magic here was that this was not an OID instrument. And so if you were a cash method taxpayer and you bought this bond, then you'd include interest in gross income when you actually received the interest. If you were an accrual method taxpayer, then something called the all events test had to be met. All events had to occur which fixed your right to the income. Now for the dollar bills, what that meant was that a holder, and just look at the cash method holder to make it simple, that holder was not required to include anything until the maturity date of the bond 10 years out. And of course, it dawned on the holders that if they sold the bond shortly before maturity, then what they could do is they convert their interest income into long-term capital gain. And if you put all that together, what you end up having is a really neat result from a federal income tax standpoint, because you get deferral of what is otherwise ordinary interest income for 10 years, but you also get converting ordinary interest income into long-term capital gain taxed at lower rates. And so that was the dollar bills, and unfortunately or fortunately, depending on who you represent, that result is no longer obtainable. And that's what we're going to talk about now, is what is the current law for structured notes, and how do we classify those notes for federal income tax purposes. Now with that, I'm going to turn it over to my colleague, Remelt Reigersman, who will continue on from here.
All right, thanks, Tom. This is Remelt. As Tom said, things have changed since dollar bills. Notes have gotten increasingly complicated and complex in terms of the bells and whistles and the terms, the underlyings, etc. And so the question becomes, we've got to wade through that and figure out which tax rules apply to which structure. And so in order to successfully do that and figure out what the tax treatment is under the current rules, we've come up with essentially a tax classification for structured notes. And so what we've done is we've said, well, let's divide structured notes into three categories: type 1s, type 2s, and type 3s. And to determine in which category a particular note falls, we got to answer two questions. So the first question is the instrument principal protected? And if the answer is yes, then we're going to treat it as a type 1 note, which essentially means it's debt for federal income tax purposes, and we can look to the rules that apply to debt, and we'll go into that a little bit on the next slide. If the answer to the first question is no, the note is not principal protected, then we get to a second question, which is, does the instrument or the note bear a periodic coupon? If the answer is no, so that means the instrument is not principal protected and does not bear a coupon, we're going to treat it as a type 2 note, which is essentially an open transaction, and we'll get to a little bit more of the details on that one as well. Or if the answer is yes, so that means call that a type 3 note. There are no tax rules that address the tax character of type 3 notes, but the market has essentially come up with some self-help rules, and so there's a few alternative characterizations that are being applied there. And so the point of this framework essentially is to be able to look at any note out there in the market by using these two questions, figuring out whether the note falls in a type 1, type 2, or type 3 category. And then when you know that, you can apply the rules that are relevant for each category. I will say that this classification works in almost all cases. I will say that there are structures where it might be a little unclear, in particular with coupons, and when something is periodic or not periodic. So the thing to watch out for would be coupons, for example, that roll up to the back that look like not periodic coupons, but that might economically be periodic coupons. Okay, so let's take a look at the issues with respect to each category. So the type 1 notes, the ones that are principal protected, we would treat those as debt for tax purposes. Now the question becomes, what is principal protected? I think typically the market will draw the line at around 90%, 90. So if the instrument is at least 90% principal protected, it'll be, we would put it into the type 1 note classification. And so at this point, we know there's a whole set of tax rules and regulations that address the tax treatment of debt instruments. And so the note can either be a fixed rate debt, it can be a variable rate debt instrument, it can be a CPDI, a contingent payment debt instrument. And all of these different instruments could have original issue discount come with it. So a lot of structured notes, the ones that don't have periodic payments, fall into the contingent payment debt category with OID accruals based on a comparable yield and a tax table. We won't go into all those mechanics today, but at least there are detailed regulations that apply to type 1 notes, and we know how to treat those for tax purposes. The type 2 notes, so those are the ones that are not principal protected and do not bear a periodic coupon. We're going to treat those as open transactions. In other words, it's essentially a wait-and-see approach. So they're not debt instruments for tax. And they are more akin to something like a prepaid forward contract. And you'll see in disclosures different nomenclature used for these type 2 notes. People call them forward contracts or open transactions or a single financial contract or a derivative contract. So there's different terminology, but it all points to a type 2 note, which essentially means investor puts money in, is exposed to the underlying, and waits until maturity or an earlier sale to determine the tax consequences. And at that point, would typically have long-term, if it's more than a year, would have long-term capital gain or loss. In December of 2007, the IRS issued a notice, Notice 2008-2, and indicated that they are looking into the tax treatment of type 2 notes, and we'll talk about that in a little bit more detail in the next slide. Then type 3 notes, so those are the notes that are not principal protected and do have a periodic coupon. So the question is, well, how do we treat those instruments? And so there are no tax rules. There's nothing that tells us what it is for tax and what set of rules we should be applying to it. And the market treats them differently depending on depending on the issuer, depending on some of the terms, maybe depending on what investors want. But the two main different approaches that are shown on the slide are treating the notes as a unit consisting of two components, which is what we would call bifurcation. So there would be a debt component and a debt or a deposit component plus a derivative. Derivative is typically a put option. So it's as if the investor purchased a debt instrument or deposited a certain sum of money and is the writer of a put option. And so the investor would receive interest on the debt or deposit and would receive put premium under that put option derivative contract. And so we know what the tax rules are for each of those components. We know what the tax rules are for a debt instrument, which in this case would generally be a fixed rate debt instrument. And we know what the tax treatment are of put options. And so what you'll typically see in the disclosure for these instruments are a description of the tax treatment of each of those components. An alternative way of treating the type 3 notes is to say, well, there is no unit. There's only one instrument. It's a single instrument. There's only one note. I'm not going to bifurcate. I'm going to treat it as a single instrument. And so the question then is, well, what is that single instrument? And so that single instrument is essentially, it's some kind of derivative contract that has an income, periodic income component to it. And so we would treat it, you would treat it as some kind of income-bearing single financial contract. And typically people will treat the, or issuers will treat the coupons as giving rise to ordinary income, and then the back-end payment essentially includes the wait-and-see approach that we discussed for the Type 2 notes. And so it's a combination of those two pieces. Typically, if the Type 3 notes also have upside exposure in the hands of an investor, we typically don't see people take the note apart into components. In other words, we rarely, or I don't think I've ever seen trifurcation. I've seen bifurcation, but not trifurcation. In other words, I've never seen an issuer say, let's treat this as in part a debt or a deposit, and then the other parts would be a put option and maybe a call option or something like that. In those cases, we typically have seen the instrument be treated as a single instrument, some kind of income-bearing derivative contract. Then be careful with foreign currencies to the extent any of the instruments are linked to a foreign currency. The IRS has put out a revenue ruling, which is Revenue Ruling 2008-1. So that addressed an ETN linked to euros. So it was a US dollar euro note. Essentially, it was denominated in US dollars, but it paid out based on the exchange rate between the US dollar and the euro. I think the initial disclosure indicated it would be like a Type 2 type of instrument. And the IRS issued the revenue ruling, said, well, not so fast. We, if you look at it from the euro perspective, it's principal protected because you cannot lose any money if you look at it from a euro perspective. And so the IRS said we're going to treat that should be treated as a debt instrument for tax purposes because you can have a essentially a foreign currency denominated debt instrument. So what that means is when you have structured notes linked to currencies or currency baskets, we typically will set up a spreadsheet to figure out what the payout profile would be in each of the currencies and convince ourselves that it's possible to lose something in each currency before treating it as something other than a Type 1 note. And if that's not possible and it looks like it's principal protected on other currencies, then we would treat it as a Type 1 note. And then at the bottom of the slide, expectations versus legal entitlements. So the question becomes, when is something principal protected or when is something not principal protected? Now, if there's a legal floor, let's say a 90% legal floor or 100% legal floor on the return of an instrument, obviously subject to credit risk, we would treat that as a Type 1 note. But the fact that something is not principal protected at all, does that mean necessarily it is not a Type 1 note? And that's not entirely clear. And most issuers and most tax lawyers who work in this area will look to some kind of probability that a holder can lose a certain amount of its investment in order to conclude something is not a Type 1 note. So in order to be in the category of a Type 2 or a Type 3, not only should it not legally, under the terms, be principal protected less than a certain threshold, let's say 90%, but there should also be more than an insignificant probability that the principal will be eroded. All right, let's take a look at Notice 2008-2. So what happened was when Type 2 type of instruments became more and more popular, including ETNs, which can be very long dated, and essentially a holder can have a 20-year or 30-year exposure under an ETN linked to an underlying without the requirement to pick anything up, any income up, because it's a wait-and-see approach. And so the government issued a notice and said, we are aware of these transactions. There are policy issues. We need to think about how this works. And so you see there on the slide, they said, in connection with certain financial transactions frequently referred to as prepaid forward contracts, or in certain circumstances, exchange-traded notes. And the main point is, should a holder of an instrument like that be able to defer income until maturity or an earlier sale? So the example would be you got a 25-year ETN linked to the S&P 500. The S&P 500, goes up over time, but a holder doesn't have to include any income, the holder of the ETN, until the 25-year mark. So the government says we're studying this. We're trying to figure out, what to do. We're asking comments. The comment period has ended. People have, commented on it, but nothing has happened. The IRS and Treasury have not issued any further guidance or changed rules or issued regulations. My understanding is this is still an area that's under study. It's not an issue that has gone away, as we will talk about a little bit more at the end of our presentation. In terms of legislative proposals, there was at some point a mark-to-market proposal. I think there was a version in the House, and there was a slightly different version in the Senate at some point. And so under the mark-to-market proposal, essentially all structured notes would have to be, marked to market, to their market value at the end of the year, and the holder would have to pay tax based on essentially short-term capital gain, which would be ordinary income. And it looked like that was going to pick up some steam, and so presumably IRS and Treasury thought, well, it's going to be it's less important and it's less pressing for us to give some guidance on these topics of type 2 and type 3 notes, so we can put on the back burner. Now, mark-to-market hasn't materialized, although who knows what the future holds. All right, so let's take a look at a few, we got to do the CLE code. You can see that on the screen there. So the code is 04MB, Mayor Brown 28SN structured notes. Again, the CLE code as it appears on the screen is 04MB 28SN, and please include this code on your affirmation form. And both that form, the affirmation form, and the evaluation form can be found in the resources widget on the screen. Okay, so let's take a look at a few of the select issues that are relevant for structured notes. First one we'll touch on is the constructive ownership provision, which is Section 1260. So that's Internal Revenue Code, Section 1260. Essentially, what that section is getting at is it's preventing a conversion of an economic return that is not capital gain or would not otherwise be capital gain into capital gain. And so what is needed under Section 1260 is a taxpayer needs to have gain from a constructive ownership transaction. That's one. It has to be with respect to a financial asset. And if that's the case, then the gain is treated as ordinary income to the extent it exceeds the net underlying long-term capital gain. So a constructive ownership transaction includes a number of things. It refers to a notional principal contract, which is the tax term for a swap. It refers to forward contracts. It refers to paired options. It doesn't say anything about structured notes. Now, many in many cases, especially more towards the prior few years, some of the notes were called forward contracts in their disclosures. But essentially, the statute seems to be getting at instruments that are like Delta 1 type of exposure when they talk about swaps and forward contracts and paired options. I would say most structured notes are not Delta 1s, but they have some kind of disrupted, nonlinear payout profile as a result of buffers or caps or floors and leverage factors, etc. So it is not, as a result, it's not entirely clear whether the constructive ownership rules would actually apply to a structured note. So in addition to that piece, the next piece would be, there needs to be some kind of pass-through underlying link that the note is linked to, something like an S corp, a partnership, a PFIC, a trust, something like that. The ones we most typically see in the market space are really like ETFs, mutual funds, and then traps for the unwary are PFICs, to the extent there's which is a passive foreign investment company, to the extent that's included as an underlying. And then net underlying long-term capital gain. So that's the amount of long-term capital gain the investor in the note would have had if they had held the underlying directly. And so I'll just give you a brief example. So let's just say we do a structured note linked to an ETF, and the question is, okay, what would somebody, taxpayer, what would that taxpayer's tax profile look like had he owned the ETF directly? And so the ETF makes periodic distributions, and those distributions can be ordinary income. And so by holding a structured note linked to that ETF, and that structured note is, let's say, a type 2 note, everything would be long-term capital gain at the end. And so what the rules essentially tell you to do is compare the gain you have on the structured note, compare that to the gain that would have been long-term capital gain if you held the ETF. And if there's an excess, then that cannot be treated as long-term capital gain, but that would be recharacterized under 1260. It would be recharacterized ordinary income, and there would be a interest charge for the holding period. The burden of proof is put on the taxpayer because the net underlying long-term capital gain is presumed to be zero unless established by clear and convincing evidence of the taxpayer of being something else. I think what you see in the market on this topic is that it is essentially disclosed out. You see there a sample disclosure where essentially issuers are saying, look, this is not an area of the law that's entirely clear. There's a risk. It describes the risk of recharacterization and how potentially that calculation might work, which is also relatively complicated. But it's not an issuer risk. It's not a withholding tax, and so the approach the market has taken is to warn investors of that risk, and investors are on their own to evaluate that risk and determine whether or not to proceed. All right, then the next issue, the next select issue, PFIC and FIRPTA. I mentioned PFIC a little bit earlier. So PFIC stands for a passive foreign investment company. FIRPTA is the tax provisions that deal with real estate companies. And so what you'll see in virtually all offerings is a disclosure paragraph that indicates that the issuers are not going to look at all the different underlyings to determine if there are PFICs or FIRPTA type companies included in the basket of underlying stocks or in an index. So what are the consequences if one of these companies is in fact included? Well, on the PFIC side, the question becomes whether a structured note linked to a PFIC, whether directly or indirectly, results in the taxpayer, having an interest in a PFIC. And if taxpayer has an interest in a PFIC, it's a U.S. taxpayer, then they would be subject to the somewhat onerous PFIC regime and PFIC rules, which converts capital gains, long-term capital gains, into ordinary income and has an interest charge, and some other punitive measures which typically investors would want to avoid. On the FIRPTA side, it's a bigger issue on the issuer side, in the sense that there's a withholding tax to the extent a non-U.S. investor has a FIRPTA exposure. So the PFIC exposure is really for U.S. investors. The FIRPTA issue is more for non-U.S. investors. On the FIRPTA side, there's some old rules and some old regulations that address when an interest can be a FIRPTA-related interest. There's a 5% test, essentially, and so if a FIRPTA underlying is identified, you can take a look at the notional amounts of the note and what foreign investors might be purchasing to determine how we fare under that 5% test. I'm not aware of offerings being done in a size that really trips this up, so most issuers get comfortable to link to FIRPTA underlyings, without withholding. And so the type of companies that come to mind are, like home builders, mining companies, sometimes the railroad companies, since they can own the land underlying the railroad, the tracks. So that's something to look out for. And then I will hand it over for the next slide to our colleague Brennan Young, who will start off talking about some form requirements.
Thanks, Rebel. So the next one we're going to talk about is Form 8281, which is an IRS filing requirement. We wanted to flag here because it can sort of be a trap for the unwary when issuing principal protected notes. So the regulations provide that generally the issuer of a quote-unquote publicly offered debt instrument issued with original issue discount is required to file a Form 8281, which on the form you generally set forth the OID accruals that a U.S. holder would have to include. And you usually have to file that form within 30 days of the issue date of the instrument. A synonym for the issue date here is sometimes called settlement date. And note, these are not business days. These are 30 calendar days from the issuance of your note. So when is a note publicly offered? That's when it's registered with the SEC, which, as we know, is a pretty big chunk of structured notes. Or if it's not registered with the SEC, it can also be publicly offered if it would be required to be registered under the Securities Act of 1933, but for an exception from registration. And the one that might look the most familiar is an exception from registration under Section 3 of the Securities Act of 1933. So even though it's issued under a 3A2 program, can be subject to this reporting requirement. This reporting requirement definitely requires or definitely applies to U.S. issuers, but it can also apply to non-U.S. issuers as well if their note is offered at all into the United States. And there's some exceptions to having to file Form 8281, notably certificates of deposits and short-term obligations. So why are we talking about this in the context of structured notes, which are not usually sold at a deep discount or are not typically sold at a deep discount? That's because if a point-to-point instrument, for example, is principal protected, then that note is treated as a contingent payment debt instrument for U.S. tax purposes. And that essentially puts the holder on a schedule to accrue OID over the life of the instrument. Now you have an OID instrument, and now you need to file Form 8281. So that's just something we wanted to make you aware of. Moving on to the next slide, let's talk about a very popular topic, withholding tax in the context of structured notes. There's a few concepts to keep in mind at the outset. First is the U.S. generally imposes a 30% withholding tax on U.S. source FDAP, we call it. That stands for Fixed Indeterminable Annual Periodic Income. That includes, for example, and most pertinent to structured notes, interest in dividends paid from U.S. sources to foreign investors. This does not include capital gain, which is not generally subject to withholding tax paid to non-U.S. investors. So this is mostly focused on like the coupon or interest component in a structured note. There is an exception for portfolio interest, which is a defined term on debt instruments. So these are the type 1s that Rem will describe, and we'll get to that in a moment. So similar to tax classification, we find it easiest to look at the withholding context or the withholding question by grouping notes together according to the tax classification that Rem covered earlier. So keep in mind, though, that withholding can be required from U.S. payors, or it's generally required from U.S. payors that are organized in the U.S., and in some cases can be required from U.S. payors that are operating a trade or business in the United States. So it could be that foreign issuers pay U.S. source interest or payments. So let's start with type 1 notes. There's generally no withholding on the interest paid to U.S. or non-U.S. investors because of the portfolio interest exemption. Now it has some limitations in it that are really not often found in the structured note context. So some limitations to the portfolio interest exemption are a 10% ownership limit of the issuer, not very common, that an investor would own 10% of a bank. Limit on the application to note holders who are banks. Typically, banks are not the ones buying structured notes, it's more retail investors. And then finally, a limit on the portfolio interest exemption is that it cannot be contingent on the sales, receipts, income, or profits of the debtor, which again that'd be really rare for that to be the case for a structured note. So accordingly, there's generally no withholding on type 1 interest. And of course, it's worth noting here that this applies to all types of interest and coupons, but if you are a non-U.S. issuer issuing and the structured note is not effectively connected with your U.S. trade or business, then there's no withholding tax apart from potentially dividend equivalent withholding, which we'll get to later. So that's type 1s, generally not much of withholding tax concern there. Type 2 notes, again, Rem went over this, but these are notes that are not principal protected and do not have a coupon. Because there's no coupon, there's no periodic payments, and therefore not generally any withholding, subject again to the dividend equivalent rules I just alluded to. And then type 3 notes is the final category. Again, Rem went over this, but these are notes that are not principal protected but pay fixed or contingent coupons. This is an area, like a lot of areas in the structured note space, with relatively little guidance. The coupons on these non-principal protected notes are similar to interest, but the industry doesn't really treat them close enough to be eligible for the portfolio interest exemption. And accordingly, almost everywhere where U.S. source interest is being paid, or where U.S. source coupons are being paid on a structured note, you'll see disclosure that there'll be a 30% withholding tax. So next, dividend equivalents, which I have alluded to now. I'd say probably most people in the structured notes industry have heard of potential dividend equivalent withholding under Code Section 871M at this point. That's in part because I believe now DTC requires attestation on dividend equivalent withholding in connection with each issuance, so it definitely comes up. Like we started the whole presentation in general, we'll start with a little bit of history. Code Section 871M was added to the code in 2010, and the code itself imposes a 30% withholding tax on U.S. source quote-unquote dividend equivalent amounts, which can include, under the statute now, we're not talking about the regulations, which is where it really comes up in the structured note context, but in the statute itself, any substitute dividend made pursuant to a securities lending or repo transaction. So if you repo out your U.S. stock and you receive dividend flow-through payments, that would be subject to 87M. Notional principal contracts, so a swap over U.S. equity where there's a U.S. source dividend being paid through. And the last category we see here is any amount that the Treasury determines is substantially similar to those items. And that's where we got some regulations that have developed over the years that tell us what they think is substantially similar. So the regulations, they first came out, they've been around for 5 years-ish, the final regulations. They were first proposed in 2012. They were then revised proposed regulations in 2013. And then they were, by and large, finalized by 2015. So for a couple of years, I think it was 2015 and 2016. Maybe it was 2017 too. I don't remember. But the regulations were not effective at all. So it was a full delay to allow people to build their systems to take into account the systems put in place by the new regulations. And starting in, I think, 2017, the regulations applied only to Delta One instruments. And that was supposed to be just, I think, a couple of years at first. But now that has been extended through 2023 or through 2022. So starting in 2023, we'll have a full effective regime. But for now, since 2017 and for now through 2022, only Delta One instruments are captured. And whether something is a Delta One instrument is kind of a rabbit hole. It's not necessary to go down here. You can kind of bend yourself around in circles thinking about that. But just know that the methodology on how to answer the question of whether something is Delta One is not always entirely clear. And as I mentioned, the Delta One rule has now been pushed 2 or 3 times. Who knows? So I think last December they pushed it. It was supposed to be effective 2021. We got another couple of years. So it's unclear whether it'll keep being pushed out permanently or whether it'll really take hold in 2023 as currently slated. So why don't we give you just a few, we wanted to touch on a few highlights here of the final regulations for when they do kick in, and then just some concepts that apply to both Delta One, which are captured now, and non-Delta One instruments. So the first is, even when the regulations become fully effective, they're still generally only applied to instruments with a delta of 0.8 or greater. So some of the thinking that has gone into determining delta on notes will not be entirely lost. There is a couple of different sets of rules for simple versus complex contracts. But this, again, is another topic that it's not really necessary to delve into here. But as the name implies, the rules for complex instruments are very complex. And because we're in this non-Delta One environment and most complex instruments would be non-Delta One, people haven't really had to worry about that for a while. But if it does ultimately become effective, those rules are complicated. Certain indices, so this applies for both Delta One and non-Delta One. Certain types of indices are excluded from being subject to 87M withholding. So one exception is a broad-based index exception, or the qualified index exception, I should say. There's 3 or 2 different types of those. So one qualified index is a broad-based index. There's a specific set of like 8 requirements in the regulations, but generally 25, the index to be broad-based needs to have 25 components. The components can't be too heavily weighted. One component can't be too heavily weighted, and sets of components, like 5 components or more, can't be too heavily weighted in the basket. Then there's also a non-US index exception. So, like the SX5E, for example, doesn't have any U.S. components. Obviously, there's no dividend equivalent withholding tax to be paid there. The non-U.S. index exception generally applies if the index has a less than 10% U.S. following. So that's something to be aware of. If you're 90% non-U.S., it could be a qualified index. Then there's a special rule for partnerships, which can get complicated, but generally the regulations are only applicable to a partnership if 25% or more of the partnership's assets by value are U.S. equities, or if the value of U.S. equities inside the partnership equals or exceeds 25 million. The trick there is that it's difficult to tell on the day you issue your note over, let's say, an MLP, for example, whether one of these two tests is met for a partnership such that there should be dividend equivalent withholding, and further what the dividend equivalent amounts should be. So that's kind of a complicated component if you're linking to partnerships. And then finally, the question, so if withholding is required, your note is captured, when do you make the withholding? The way to think about this, I think, is that withholding attaches to a cash flow. So generally, the withholding will only occur when a payment on the instrument is made, which makes sense because there's no payment for the withholding to come out of if the payment is not made. So if we're talking about like a point-to-point instrument, there's no withholding until the maturity of that instrument. So our second to last topic is the basket option notices. I'm not sure, 2015 was a busy year. As I said, in 2015, the dividend equivalent regulations final came out, and then we also got these basket option notices, notice 2015-73 and 2015-74. These are pieces of IRS guidance that basically set forth how the IRS is going to treat certain transactions. And so these notices were targeted at the perceived abuse of certain basket option contracts. The basic example, or what triggered the notices, is a bank marketed to a taxpayer a call option that lasted a couple of years over a set of hedge funds. The contract designated a portfolio manager related to the taxpayer, and over the course of a couple of years, the manager would change components in the basket to try to make the basket more profitable. And all during this time, all these changes are being made to increase the value of the basket, but the taxpayer was not recognizing gain or loss on the switches in the components in the basket. And basically, notice 2015-73 says not so fast. These amounts should have been sale or exchange each time you switched out the components. And there's also a separate piece of IRS guidance. You see there, CCA 2015-47004, which provides a little bit more detail. The notice itself, 2015-73, just calls this basket option transaction a listed transaction, kind of a dirty word in the tax rules that basically says you can't do that type of transaction. So that's not what we're worried about in particular in the structured note space. What we're really worried about is notice 2015-74, which is broader and characterizes transactions that are contracts based on the performance of a reference basket as transactions of interest. And now this is different from listed transaction. A transaction of interest is an unsavory status that basically requires all parties, i.e. the holder, the bank, and material advisors to the transaction to report the transaction to the IRS. So this notice will treat a transaction as a transaction of interest if the taxpayer enters into a contract over a basket. The basket contract has a term of more than a year and overlaps a couple of taxable years, such that there could be a timing or character difference in the gain. And the taxpayer, and you see we bolded here, the taxpayer's designee has discretion and exercises the discretion to change the assets in the reference basket. So why are we talking about this in the context of structured notes? Well, as we know, a lot of structured notes are linked to indices. And notice 2015-74 is drafted broadly enough that an index provider could be treated as a taxpayer's designee, potentially. So what we have to do here is review any new and untested indices, sometimes even proprietary indices, carefully to make sure there's not discretion in how the basket or how the index rebalances itself. There are certain exceptions to the notice, as we put here as the last bullet, for widely used or publicly quoted indices and changes to administer an index. For example, if the company is merged out of existence and the provider needs to put in another component to fill in the index, that's not what we're talking about. And then also notice 2015-74 importantly has an exception for anything that is principal protected. And that's because, for example, if you do a point-to-point that is principal protected, all the income on that is going to be ordinary for U.S. tax purposes anyway. So there's no conversion from an ordinary tax rate into for short-term capital gain to a long-term capital gain rate that would be 17% lower. So with that, I'm going to turn it over to Tom for a discussion of the tax considerations, or more, I guess, a lack thereof at the moment, for structured notes related to the current pandemic.
Yeah, thanks very much, Brennan. Well, I mean, no presentation these days should go without at least talking about the current crisis. And you see on the slide, I mean, there has been just an absolute avalanche of guidance and statutory changes, all designed to help taxpayers, help the economy, relieve pressure on the economy. And I think, you're probably all familiar with most of those. As you can imagine, none of this has anything to do with structured notes. We do see issuances of structured notes throughout this crisis, maintaining certainly not at the levels for the first couple of months of the year, but at significant levels. We saw this with the financial crisis as well. Brokers are still talking to their clients. The clients are still looking for investments or targeted investments. Many of the structured notes, are an investing theme, for example. And so that's still going on. And, in some cases, with some clients, the volumes are actually up. So this market is still here. But the final words I wanted to sort of get out there are about what is the future of the tax treatment of structured notes. And as you've seen, the tax treatment has evolved over decades to where we are today. And by and large, for instruments that are debt-like or that have a coupon, the holder is picking up current income. You can't do what was tried with the dollar bills. And for instruments that are contingent, you basically under a wait-and-see taxation regime, with taxation when you figure out what the contingency, how the contingency resolves. And that's been the system ever since 1996, when the OID regulations were finalized. So where do we go from here? And I think what you would look at is the need for revenue, because as you know, Congress is spending an awful lot of money right now. And so there will be in the future a need for revenue, and that's as plain as the nose on your face. If I guess the way to think about this, no one knows what's going to happen in November in the election. If President Trump's reelected, then I think you would see a situation where pretty much what we've seen in the last 3 years. Not a whole lot of interest in structured notes, obviously, and to the extent we see anything, we see a little backing off on regulation. On the other hand, if you get a Democrat elected, then you're probably going to get a different, an entirely different view of revenue raising. And by that I mean that they will be looking for sources of revenue. And they will also be looking at many of the proposals that have been in the presidential campaign so far on the Democratic side. If you take a look at our tax quarterly, we try to cover those. It's called the Mayor Brown Capital Markets Tax Quarterly, and we cover those. And I think some are going to be included in your materials. But you would look at Elizabeth Warren's proposal to tax basically value of assets for taxpayers, very large taxpayers, very rich taxpayers. So, those are the places I would look to try to figure out what that particular future likes, it looks like. So with that, I think we're all done for this afternoon. We really appreciate you taking the time to listen. We hope you have found it helpful. If you have any questions, shoot us an email. With that, I'll sign off. Thanks very much.